All right, guys, large orders then. We're doing this following absorption. Now, a large order is essentially a much less subtle version of absorption. Rather than trying to disguise the size that somebody has, they just show it. Now, there can be many reasons that someone will want to do this. It could simply be a way to execute whereby they put their order in, they don't overly think about the size of the order, it's just, we need to sell 1,000 lots, put your order in. And that could be one of the reasons. Other reasons could be that somebody is chasing to get their order filled, a sign of desperation, and a large order will then get dragged towards market. Alternatively, it could well be that somebody is just purely waiting to get their business done. They act on the back of, start that one again. Moving on from absorption, we now come to large orders. Now, these are a much less subtle version of an absorption. Whilst an absorption will try and disguise the amount that somebody has to buy or to sell, a large order shows the whole lot immediately. It shows up clear as day on your ladder. Now, people could be doing this for any number of reasons. It could well be a sign of desperation. Somebody has an order that they need to get filled, it doesn't get filled, and so they drag it towards market. And as they do, that's quite obvious. You see this large order moving through the book. Other situations you will have where somebody has an order that they simply are asked to place an order, the order gets placed. It may show up very, very large, but somebody is happy to just say, that's the price, I want this many contracts at that price, they will leave it there. And equally you get reaction to comments, reaction to news, and large orders, particularly at that point, become much more obvious because markets generally thin out as well. So these larger orders appear in the market and that can then drive the action. So the key question with any kind of large order that you need to answer before we look at different strategies around trading them is the question of, is it genuine or not? So, a few questions then. The first question, of course, before is it genuine, is it a large order? Now, you can try and quantify this. You can try and say, oh, well, it needs to be double the size of any other order in the book. It needs to be triple the size, 50% bigger, whatever that number is. Trying to be specific on quantifying it, I don't think is necessary. A simple way of thinking about this is to ask yourself, is that a large order? And if your answer is, I'm not sure, then it is not a large order. Because if you're not sure, nobody else is sure. If nobody else is sure, no one reacts to the large order. So really the question is not, is it large, but are other people going to react to it in a way that you would expect? Take, for example, any other walk of life. You're driving down the road, you see another car, you could very quickly say whether that is a large car or not. You don't need to know the dimensions. And that's the point, the same with a large order. It shows up, it's obvious, and if you're not sure whether it is, it's not. Take this example here, S&P one, 3,200 on a book that, very easy, you don't even have to look at the numbers, triple figures on most, and now you have 4 figures and 3 times over 4 figures. It's obviously a big order. That's the way that you want to try and approach these types of things. The key to a large order is a bit like an absorption, but more obvious and more bluntly, it forces action. If you wanted to buy, and now there is a large order at the price you were going to buy, you immediately are going to be right at the back of a very, very long queue. Do you want to be there? What's your chance of getting filled now? That's what you've got to ask yourself. And so if there is a large order there, then it's saying to you, perhaps you may need to pay a higher price. And this forces action then. If a large order appears, anybody who's already looking to buy, if it's a large buy order, somebody already looking to buy now is forced to buy because they can't get filled where they wanted to. And the other aspect of that is if the large order moves, then that could drive price further and encourage more and more buying. So that's the kind of influence of a large order. It forces action. It forces people to make a decision, particularly if it is newly apparent. If it just appears, all of a sudden you have to change and react to that. So that's the key bit. So back to the question of, is it genuine? Because there's no value in seeing a large order if you don't believe it's genuine. And we'll come on to this in the next section where we look at flipping large orders that are not genuine. For this part, we're going to focus on large orders that are genuine, that we can be confident it is a large order and it's a large order that wants to get filled. So ways to deduce how genuine the large order is. First up, duration. If a large order has been resting for a long period of time, sitting in the book for a long period, and you've seen that every time we approach a certain price, that large order is always there, it's a fair assumption that this is real. The reason for that is it requires a significant amount of margin to place a large order. And so Therefore, nobody's going to forego a lot of margin, forego the possibility of being in other trades to leave an order waiting unless they want to get filled there. So that's one assumption that can be made. It is highly likely to be real. But the impact of a resting large order is somewhat limited, and we'll cover this when we look at front running in a moment. The other key identifier of a large order being genuine is movement and consistent movement. So what I mean by that is a large order that moves towards market, rather than a large order that appears and then disappears, and appears and disappears. It needs to move towards market. What this shows is a sign of desperation. Somebody has an order that they need to get filled, and they will drag it towards market in the hope that the closer they get, somebody will come and trade with them. So you imagine this large order here moving up in the hope that somebody then sees that at these prices, it's worth selling 3,000 contracts. That's another good sign. It's a clear indication of a desire to get filled and somebody trying to not pay the highest price or not have to hit market. Imagine if this large order hits market, how many prices could it take out? So what they're doing is they're trying to keep the large order there to enable them to get filled by somebody coming in and thinking that's a high enough price we can sell to them. Context also matters. When the large order appears. A fair assumption is if a large order appears directly after a piece of data, directly after a news story, it is likely to be real, particularly if it comes in, well, I'd say particularly if it comes in the direction of the news, but in either direction really. Because with such volatility and volume that will follow any kind of news event, nobody is going to place a very large order unless they want to get filled, because there's a high likelihood that they will get filled. The large order will essentially be used as liquidity, and we'll cover that when we look at a hit and run strategy. So context matters. If you see a large order appear after new information has just hit the market, it's a fair assumption it's real. Movement is key, as long as it is consistent in its direction. And resting orders that have been resting for a long duration are also highly likely to be real. And remember, the key thing, it has to be anomalous, it has to be obvious. If you're not sure, nobody else is going to react to that order either. And that's the key bit. It's about whether there's going to be reaction. If you don't see a reaction coming from this large order, it's not relevant to know that there's a large order there. Let's go and have a look at the first large order strategy. This is one involving what we call a front run. So here we go. Simple idea of a front run. You see the large order, you place your order ahead of this. Be this offer in front of a large offer, a bid above a large bid, whichever way round, it doesn't matter. So, quite simple, you're going to enter ahead of the large order with a tight stop behind it. This is a trade that can offer you potentially a 2-tick stop. You buy, you have the large order, your stop goes below that. There is no reason to place your stop any further down. If the large order breaks, the market should then go through and continue in that direction. So therefore, stopping out 5 ticks below the large order is just paying 4 more ticks than you need to do. So just bear that bit in mind. There's no need to take on risk and lose money unnecessarily in this situation. In terms of the reaction that you're going to get though, this all comes down to context. As I talked about with absorption, the key thing with any kind of order flow is the question of why are you doing it? Why are you front running this large order? Are you front running it purely as a scalp trade to make the most of the bounce away from the large order as people react to seeing that large order and the market is influenced, people have to execute? Are you playing for that and just taking advantage of that short-term reaction? Or are you using the large order as an opportunity to get yourself a very, very tight stop on a trade that you already want to take on? So a situation where you have a level, large order at the level, there's your opportunity to front run the large order and give yourself an ideal entry point. You get to buy the level with a 2-tick stop, and as long as the large order holds, you've got yourself a trade that puts you under no pressure and gives you a perfect entry for a larger directional move. So you have to make that decision before you get there. If it's just a reaction to a large order, it's a scalp. If it is a trade you want anyway and the large order appears, then you take the trade you want anyway with added quality. It adds that extra little bit of boost to your trade, that extra little bit of information that says this trade is probably going to work now. So, 2 different types of large order to front run. First up, moving large orders. These are typically going to come in once a market shows direction. So whether this is a fast market post a piece of data, whether this is breaking news, whatever it is, you can use that large moving order to get in ahead of. The idea here is that as the large order continues to move lower, and I showed you one example of this in the first week where we looked at entry and exit strategies, but as that large order moves lower or moves higher, you can continue to pyramid ahead of it. Now, in a situation like this, and I'll give you a couple of examples of this, accuracy is not necessarily extremely important. You don't need to necessarily get one tick ahead of the large order. You need to make sure that you're getting in, and if that large order continues to move, it pushes you on side. You can add again and again and again and again. Over time, and this is the key thing to remember, over time, with a large order, you will move to a price where people see that as value to trade into it. So let's say this is 1,000 lot moving down the market. As price moves lower, somebody who wants to buy, the price is going to get to a point where they think it's worth buying 1,000 now, and they'll take all of that 1,000 lot away. So beware of that side of it, that as soon as that order is filled, the trade is over. But the benefit of a moving large order is it creates immediate reaction. Because if I'm considering selling and someone places 1,000 lot on the offer, I need to act quickly. If the market's already moving in that direction, there's already a willingness to sell. Now people get given the kind of urgency that they need. Is that you have to do this now because the large order is going to take your opportunities away from you if it continues to move down. So people transact quicker. You need that little bit more urgency in your trade, but it means that reaction is immediate on the large order. People react to it, the large order moves, and once filled, the trade is over. It essentially gives you a moving stop, that your stop is the large order. As the large order follows down, you can hit into it to exit the trade. One thing to be aware of in that situation, hitting into it to get out of the trade, you have to accept that it may still continue. Don't worry about that. That's not what you're trying to do. So there is always a situation where a large order will come in. I'll show you this on an image in a moment. Come in, push down, you get out because the large order gets traded into, the large order returns and the market goes again. That's not the trade you're after. If you've got out, you've achieved what you wanted, get out the trade, leave it alone. Because another day, the large order will follow down, get filled, and the market will reverse straight back to where it came from. In terms of your profit take on something like this, you can continue to just add ahead of that large order and then exit into it. Chances are that your final adds are you're almost likely to lose on, because you will keep adding in front of the large order until the large order is filled. So you're looking potentially a very quick profit, and in a quick market, it could be that you only end up with one tick of profit when these types of moves come in on your final order. But the earlier ones, you're expecting to be able to make some money on those relatively quickly as the market progresses in that direction. With a resting order, you have a slightly different situation. Like I suggested before, a resting order is likely to be genuine, but the problem or the difficulty you're faced with a resting order is it has clearly shown no desire to move. So if it's not willing to move, you now have a situation where this order is sitting there. If the market creeps towards it, it's not going to get out of the way. And so it's not going to instigate trade selling ahead of it, for example. If you have a large offer, market drifts up to it, nobody's going to rush to sell ahead of it because there's no reaction to it. The only situation where a large resting order can be used as a front run is when you get a quick move to it. The market zips towards it, and in doing so, that creates a reaction, because if a market moves quickly to a large order, people who have got long, say running up to a large offer, will look at that as an opportunity to take their profit, an opportunity to exit their trade, bang, 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 up to it, exit, and the market then comes off quickly. But you're trading this for the reaction. Essentially, you're taking advantage of the people profit taking, which is what pushes the market back down. So that's the way that you've got to think about the stable ones. Moving ones will constantly show you when to get in and how long to stay in. Stable, resting large orders will only give you an opportunity if the market zips towards them, meaning that you're then going to get the reaction back away from them. Final thing with a resting large order as well, as I bring you onto a sort of descriptive image, is that you can continue to play the trade until that order disappears. And I'll give you an example of this in a moment. So what I mean by that is if you get in the first time and the trade works, your stop is still very minimal. If it comes down again, you can still take the trade on. You've still got a minimal stop, and yes, the second time, it may be less likely to work, but your risk is very small. And if you don't take it, you then end up foregoing the potential of another bounce for the risk of one tick when you've already perhaps made 5 to 10 ticks on this trade. So let's go and have a little look at a couple of different examples. Resting large orders then. Key bit here, what you really want to see is this quick move towards it. This bit is important. If the large order just happens to be here and the market is just bouncing on it, you don't really want to trade that because the large order is not going to move. So over time, if people start to trade through that large order, it will just be filled and the market will get on with doing what it wants to do. Essentially just slows down what's already happening. But this zip down to it, as long as that large order doesn't disappear, it's unlikely to, it's been there all day, the sellers who have suddenly got themselves on side on this move are going to view that as a great opportunity to take some profit. So you zip down, bang, profit take. This creates a quick bounce back up. This move should be fast. You expect, if you buy ahead of this large order, to go on side quickly. You don't want to see a great deal of volume being traded into the large order, into the large order, into the large order. You want to see hit, reaction, bid back up, or hit, reaction, offer back down. And essentially, it's people scrambling to take their profit because it's the short-term traders who take advantage of the quick move down. They scramble to take their profit there. Moving large orders give you a slightly different situation. What's going to happen here then? As a market starts to drop, a large order may well chase. And so it will appear at each of these red marks and then move down as the market progresses. You will get bounces back to it, and this is your ideal opportunity to enter. You can sell ahead of that large order, stop just behind it. Now, over time, if that large order gets hit, the person wanting to sell in this example is getting the business done. And so that large order, as it moves lower, is likely to decrease in size. As it does so, it's going to be more and more likely that it gets eaten up for two reasons. One, the lower it goes, the more buyers are going to be thinking this is a good price to buy, and you now have a large order offering you a decent amount of liquidity to buy. Secondly, people are going to get short ahead of the large order, and you will end up with a situation where there will be more people short just because of the large order than the size of the large order. So if you imagine that this large order starts off as 1,000, there's 2,000 lots sold ahead of it. All of those 2,000 contracts cannot get out by hitting into the large order. And so therefore you have this large number of very short-term sellers who are all looking at the same reason to exit. So that's why you need to be very aware of the size of the large order decreasing. As it decreases, that's going to give you reason to hit into it because people are going to be looking at that as an opportunity to get out of their positions. So that's what's going to happen. It will chase. Each time it's tested back, it typically is going to reduce. But as long as the market velocity remains, as long as you don't see it trade back to it and then it stalls and then trade back to it and it stalls, as long as you're not seeing that, you can expect continuation. And you want to see that large order continuing to move down in line with the market's direction. As I say, once that large order gets eaten up, gets hit into, that's where you take your profit, and you can then expect a quick jump back up, because the reason for the market to be down is partly because of the forced pressure of the large order, as opposed to entirely on the market's own desire to be down at these levels. So let's go and have a little look. We'll start off with a resting large order. This is an example in the pound. Now, you can't see the large order at this point, and that's key. So people who are trading this market are perhaps looking at this thinking, right, well, we're going to try and play this move down, and the bit of the move we're going to look at, trading just below 40, we're going to look at this first move down here. So you know this is going to hold, obviously. It's a resting large order. But the idea behind trading it is all about the move to it. That's the bit that matters. So I'll bring this ladder up and let's go and have a little look at it. Here we go. So trading around about 127.36 at this point in time in the pound. So if anybody's looking at this thinking, yeah, there's an opportunity to play a quick short on this. So on the 1 minute chart, you're playing for this little break down here, and the continued break of this low as well. And this is the bit of the move that we're going to be tackling just here. So if you're looking at this, there's not a great deal going on at this point in time. You're waiting for the break of 30, 34, 35, the low of this mini range just here. That's the bit that we're after. So reasonably stable, no reason to want to be overly active on this trade at this point in time. Market stays nice and slow. So right here, there's no reason to want to do anything. Still not a great deal going on. We traded 34, we trade 35. We got nothing at 34, we trade down a little bit. Small amount of selling, pick up in pace. But you see there, all of a sudden, there's a large order at the low. This is your opportunity to buy. You see the large order drop down, you can place your bids ahead of that, and you get the quick reaction. What you're playing for there is the people who suddenly created that quick move down, that moved from say 32 down towards 22, all of those people thinking now's the time for a larger move lower, suddenly encounter the large order at the low. As soon as this is spotted, they have a problem. They're short, you've now got a massive barrier in your way. As such, people run for the exits, they go snap, 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 take their profit. This creates a quick bounce back, and there you have it, straight away back up towards 32. You're not looking to take on any more than this unless you believe this is a significant level that you want to buy and hold from. If it is purely a scalp trade, then it is nothing more than get yourself in, skip up, and it's all about where does the move come from? Where does that initial pace come from? That's your target on a trade like this. The stop's dead simple, just below the large order, zips down, filled, stop below, back up. Notice here that there isn't actually a stop placed. You don't have to have a stop placed. One way to approach this is to, as you get filled, hover your mouse just above the large order. So by hovering your mouse over the large order, if it does start to trade, you can hit into it to get out of your trade. So if you just watch this one more time, you'll see this move come. So as I say, still not a great deal going on. You wouldn't want to rush to get into this trade at this point in time. Now you get that bit of pace, 32, 3, 2, 1, bang, 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 straight down. There's your large order. Your stop is down at 20. That's the bit that you're interested in. So you're thinking, right, my stop is at 20, but you could also be ready. If we start to trade into 21, then you could hit into that large order, meaning that you're going to take a smaller stop on the trade. You saw where the origin of that zip down came from. That's your target. As soon as you get back up there, the job is done. You've taken advantage of people profit taking after they tried to play a breakout to the downside that ran into a massive wall. This trade comes around a second time as well. And we'll go and have a quick look at that now. And here we go, version 2. This is the second attempt down towards this large order. In this situation, it is not such a quick move down. You see it's a much steadier drop down to the large order, not a big spike as in the first version, but a steadier drop down to it. And so you can approach this in a different way. There's still some value in buying ahead of it, remembering that you took 10 ticks out of this last time, but you can see already it's a much slower auction. There's a lack of pace in the market here. So whilst you can take the trade on, conviction is going to be that little bit lower. So as we then start to tick down to it, happy to leave a bid just ahead of the large order. And what we'll see here is what can happen with large orders, and the reason that you perhaps wouldn't want to hit straight out into them, because they don't always get entirely filled. But clearly this is a person who has this bid here, they want their business done and they're not willing to move that. That's where they want to buy 1,200 contracts, and they're going to wait until they get filled on them. So not a great deal going on. You can get filled and the market stays very, very stable. This is where realistically you perhaps don't really want this trade. But because you've already taken 10 ticks out of it, there's value in risking those 2 of the 10 to try and play for the same thing again. If you don't find any more sellers. So in this situation, it's not about zip down and people profit taking away. In this situation, it's about not finding any more sellers. If we run out of sellers, the market won't be able to keep on going down, and therefore it will then bounce back. If you don't have any sellers here, they're all going to move out of the way as the market starts to roll away, roll back up towards 30. It does take a lot longer to do this though. It's a much, much slower move. But you see here, few orders been hit into that large order. No reason to rush to get out in this situation. This is just purely one where you'd be thinking, the way I'd be looking at this is, if the pace of orders, the pace of the sell orders increases rapidly, that's a good reason to get out of the trade. Because that's indicating you are finding sellers. Sellers are coming in nice and quick, and there's your chance to get out. In this situation, we're not really seeing that. Yes, we traded 233 into the large order, but it's slow. And so therefore, there's not a great deal of reason to want to panic on this one. It is just purely a situation where there's a few hits into it. Starting to pick up, and I'd be looking at this in my head thinking, okay, I'm seeing the pace of the orders going through. If I start to see a faster tick, 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 tick than what we've been currently seeing, then I might want to be out of it. That's quite quick and could well be a good enough reason to get out. Still doesn't exhaust a large order. The only reason that you'd be willing to stay in is that you have further large orders below that could offer you some protection down at 17 and 18. So it does mean that we could see a sort of flick through, hits the next large order and then bounces back. So you can have a little bit more confidence here, but it's not an ideal situation. For many, I think the fair trade would absolutely be to be out of this at 21. The reason to buy there has gone. You were buying because there was 1,200 contracts. There's not 1,200 contracts anymore. And for that reason, you don't necessarily want to be in this trade. And so therefore, I think there is fair reason to want out, but the market does completely stabilize. If we move this forward slightly, you then end up with a situation where we bounce away from the low, we filled the large order, it never trades through it, but I would then very much have offers much, much tighter. I don't want a great deal of number of offers or trying to go for too much here because the large order is gone. Willingness to buy more, fair enough, because we have now moved away from the large order and we're holding a bit higher. But overall, I'd be looking to get out of this, not looking for too much on this trade. And a much more sort of muted target. There we go. Steady drift up, steady down to it, steady drift up. Not the same as that fast whip and scalp back that we saw on that last example. And to follow on from this, we won't use the ladder on it to show this, but whenever you see situations like this, you will often get a persistence of orders of such type. This could well be somebody trying to buy over a much longer period of time. Remember, as I talked about in the earlier weeks, think about people's motivation. Somebody who has a huge amount to buy is quite happy to get filled over 100, 200 prices. And so therefore, as the market continued, and this is now just shy of 200 ticks lower, the day later in the pound, you still saw the same. Another 1,500 bought at the low, 300 filled out of a 700 bid. So there is somebody seemingly willing to buy as the market drops and continually add to their positions in this situation. That's something to watch out for as well. If you see it once, expect that this type of order flow or this type of large order could well appear over the coming days. So there's a resting large order, and we can go and look out for these more and more as we move through this next week or so, and we'll bring these up as we see them in real time. So what we're going to have a look at now is large orders chasing. So this is a situation very common after a piece of news, but also technically we're in a great place for this. This is an S&P move. We've had a steady grind in the overnight session, which gives us a market that is inclined towards the downside. If you can break the little range of the overnight session, that's 65, 64, then we have the opportunity to go and shoot for this previous cash session high. Now, we're not going to look at the entirety of this. This is a 2-hour chart. It's an hour chart, so it's going to give you 2 hours worth of movement. I can give you the details. You can replay this. But we will go and have a look at the early part of the move as we start to progress towards 64 and through 64, and the larger orders start to chase this market down. This gives opportunity to add ahead, get into a market as it moves, and continue to add with the large orders to help you progress your move lower. The instigation of this is data. This is CPI data. You also have an illiquid market below. So you have the context that's right for this. You have a market that's already poised to drop. So you're not going to have many buyers in this area anyway. So as the market starts to drop, any large orders can be easily front run and will influence the market quite significantly. So let's go and have a look at this on a much shorter time frame. This is it on a 1 minute chart. The first move over the course of 4-5 minutes is around about 40 handles in the S&P. Now, if you're taking the trade ahead of the large order, we're not going to worry about precisely where it's going to get to. We're going to look at this from the point of view of, if you have this large order, where are you executing? Where are you exiting? So that we can then see the progression of movement. There's also, take note of quite a significant amount of absorption in the opposite direction as well. We'll bring this ladder up and we'll go and look at this as it goes and look at where the large orders appear within this move. This is what you don't see from a candlestick. You see a lot of volume, we know a lot's happened here, but you don't see precisely where it is or where you could enter this trade. Okay, here we go. This is CPI data, so the first movement when I press start is going to be very quick. That's fine. We're looking at then what happens afterwards. Remember, you're not going to be able to get in on data this quickly. So you're looking at the order flow that comes after it. You know what the data is, or if you've read the data, you can see that this is the reason for the S&P to drop. So here we go. Trading 76, 77, data comes out and we drop nice and quickly. Traded down 74.5. At this point, not a great deal to be seen. There's 100 lot, not a massive order at this point in time. You can see a fair bit of volume has been done here, and there's a constant battle to get through these orders. You see there, a lot of absorption down at the low at 70. So there's your first sort of key level at 70 there. And we've now dropped through. So if you want to take this on as a trade, the absorption has been broken. You can sell below the absorption. Use 70 now as your stop, and we're seeing more and more absorption down at the lows again. So at this point, there's no large orders to be chasing. You see, again, same principle, large absorption coming in down at 64. You can use that as a point to sell. You've got your stop up at 68.70 as well. Now you get 1,000 comes on. You see that come on the offer? There's your opportunity to sell. As soon as that 1,000 lot appeared, you can jump in ahead of that. We've seen these various different absorptions at 70, at 68 and a quarter, and then importantly at 64. So there are people clearly trying to buy as this moves down, but then you get that 1,000 that comes in. There's your chance to add on to the trade. So we'll continue this onwards, and now you're seeing more and more 100 lots. Another 1,000 comes in. And so each time that 1,000 comes in, it does disappear and turns back to 100. It's influencing the market, but it seems as well that each time it comes in, the large orders are essentially being split then into these multiple hundreds. So if you're short here, you've got yourself into a reasonable position, you're short, your stop now is going to be based on these large orders getting traded back through. So let's go and have a little look at what's going on. Keep trading back towards 60, and that's fine. You could have a bit of a stop above 60. But at the minute, the reason that we're in this trade, one is the break of 64, but secondly, is these large orders chasing. So there we go, quick little flick back up. You see an absorption coming in at 59 again. So far, each time we've had that, we've broken it, and we drop again. Same principle once more. So you can now start thinking, right, anything that comes back up towards 58, you get another 300 comes in. This could be your opportunity to exit trade. If we start to trade above that, you can then sort of hover your bid, your cursor around the 56.5, it's gone. There's a reason to get some of your trade out. Market pushes down again. This way you don't necessarily have to rush to exit completely. As long as the pressure continues, you can stay in this trade. But the entry point on this, yes, 64 was a clear reference to one to enter. Now we get more and more large orders chasing down. 64 is a clear reason to enter, but you're in a situation where the large orders are saying now you can do it. It's giving you that sort of pinpoint timing accuracy that says now's the time to get involved in this trade. And in following this down, any of these bounces, we're no longer seeing large orders coming in. This would be a reason if you're trading off the large orders to start thinking about exiting trade. And you can do that by just laying your bids lower down. You don't need to go chasing this up. But if the large orders have disappeared and they're no longer coming in, once the market stabilizes, you don't necessarily have a strong reason to be staying in the trade. You can try and trail a stop, and that would be an alternate way of approaching this. Just trail a stop behind where we've seen previous absorption. But clearly, the dynamic has changed now. We're not seeing this constant absorption at lows anymore, and we're not seeing the chasing of large orders. If you're already in, that's fine. We're in a reasonable place to try and hold on, particularly if you have targets towards the downside. If you don't have targets towards the downside, i.e. those previous daily highs, which are 34 and a quarter, then you don't have any reason to still be in the trade. If you've got a technical reason, the large orders have given you great opportunity to get into this trade, to hold on to this trade, look for that target down towards that sort of 34, 35 area. And you see, as we progress down, there's no real bounce here. So whilst we covered some as it did stabilize around about the 50s area, as it progresses down and we don't see any further bounce and this constant pressure down, there is limited reason to want to get out of this trade. You can look at those large orders that you see just down here to front run to exit, and we've actually got out of the position fully already. You can use that as a place to exit, or alternatively, if you are looking for 35 as your target, get your bids in. But it's the entry that was massively helped by those large orders here. As we came down and we saw 1,000 come in and another 1,000 come in, this gave you the opportunity to enter. Those thousands were never filled. We've still got the persistence of hundreds, 150s following down as well. And this constant pressure is what drove the market through 64. Technically, you would want to be short here anyway. And so this just gave you a great opportunity to get short and then stay short for the technical target you're after. So there we go. Very, very fast large order trades in a pretty volatile S&P. What I want to go and have a look at now is one in the 5-year, so that we get to see the difference between a very fast S&P and a much more steady, thicker, smaller range market that is the 5-year. We're going to go and have a look at, again, a similar move post a piece of data in this market. We're going to look at the break of the lows, which came on a comment during a Fed decision where Powell suggested that inflation was much too high. This is negative for bonds. And then we're going to look at the bid back up and the final drive into the close. So this is a more fundamental piece of information that creates this large order that chases. This is a more sort of technical market mechanics, if you will, reason for a large order to chase into the close. So let's go and have a little look at these two. Okay, let's go and have a look at 5-year, slightly more subtle in its movement, but still very, very obvious large orders. Here we see market with around about 300s average on each bid and offer. we'll go and see what happens as you get a large order begin to chase this market lower. So sitting stable, at this point, you would be listening to Chairman Powell speaking, explaining monetary policy decisions. So there's no necessity to jump into a trade here. Market is generally marginally tipping towards the downside equally. So if there's one thing you're perhaps inclined towards, it is more inclined towards a sell than a buy. But at this point, sitting there reasonably stable. There you go, there's the first instance. You see this up at 067, 4,200 lots. Straight away, you can be thinking, right, I could sell this here. And one thing to consider when you're doing this is make a quick judgment of 4,000 contracts. If this hits market, if this person decides I need to sell them, how far is this going to go? Assuming that we're around about 300 to 400 contracts on each price, you'd be fair to assume that this could send us down 10 prices. Therefore, very, very quick judgment. Your risk reward is a risk of around about 1, 2, 3, 4, 5, 6 for at least a 10-tick winner if they go and hit market. So there is some value in a fast market of hitting as that large order appears. Do you get filled? Just about. So we've got filled. Now you can add again. The large order drops down. We're now down at 052. So now you can place your stop above. You can be thinking, right, my stop can go at 055. And now considering the same again. This hits market, we could be looking all the way down towards the lows of the day. So all the time now, as it drops, you can continue to add ahead of the large order, with the view that if the market then starts to trade back into it, you can exit. You want to see this continue to move. We're now down at 045. Are we moving any lower? No, this is a little bit of a worry if you're trading ahead of this large order, but as long as it's not getting traded into, whoever's got this to sell is potentially still going to move the order down. So you're still looking for this continuation. You've got the low of the day if you want to put some bids in to take some profit on the trade anyway. The large order is still resting now. So it seems that whoever wants to sell has lost the sort of desire to sell at this point in time, or recenter. And so for that reason, you can't necessarily expect to add on. There we go, boom. Drops down, 2,000, dropped down, and was hit instantly. This is your chance now to exit. And remember what I said previously, it doesn't matter where this goes from now, this large order has just been hit. So straight away, you would want to be getting out of this trade. Even if we have a situation where it continues, and it does here, but you don't know that that's going to be the case. That could well be the end of the move. And if that's the case, you don't want to be holding on to this trade. So there you have it. Nice quick move. But you see, we moved down from 6.7 to 02.5 on with that large order. So we moved all of this distance. You could take all of that with no understanding of what's been said, no technical knowledge at all. You just see that order flow, trade ahead of it, and there you go. You take out 4 full ticks in the 5-year. And we see the same again later on in the session. We'll just move on to that one. As we come into the close, this is moving into the final couple of minutes of the day. Complete upper side of the range, and now desperation shown to buy. Potentially people trying to get out of short positions into the end of the cash session for bonds. We'll bring this one up now. Okay, so here we are coming in towards the end of the day. We're now trading at 272, so we're just ticking up through the highs of the day here. We've got around about 2 minutes to go to the close. So at this point in time, no reason to be rushing to do anything. Equally, we are on a reasonably strong push up, but no rush to get into a trade. And order flow wise, you're just looking at more information to come in that's going to potentially help you in taking this trade on. So still waiting this out. We're still waiting to see if anything's going to happen. Are we going to get an opportunity to trade this into the close of the day? At this point, not a great deal going on. Back down towards 25, sitting reasonably stable. Nothing more to be thought. So here we go. This is going to be the move into the close, the final drive in towards the end of the day in the Tino. We're approaching what has been the high of the day all day, up towards 112.28, currently trading down at 112.25 and a half. So this is moving into the last 2 minutes. If there's going to be some action, you're going to see some volume. This is where you'd expect it towards the end of the day. So here we go. Not a great deal moving just at this point. You can see there's still passive orders moving around a fair bit. So there's definitely activity in this market. This is good. This is a sign that you could see some movement. So you're just waiting, and there you have it. Very, very quick. 3,000 pops up, 25 and a half. Straight away, you can be in this with a stop just below. So we're ready on this trade now. Looking for this to move higher. We've just ticked up, so we now got a bid at the point where we're in. Wonderful. You can target the high of the day. on this one, being aware that if we start to trade into this large order, you're happy to get out. You want to see this move up, ideally. That's going to be the perfect scenario, where this large order moves up. It's not moving. One of the other things I'd be watching for here, and there we go, it chases. As soon as it chases, you can try and sell against the large order. The reason for the sell is that this order has just suddenly shown great urgency to move from 25.5 straight up towards 27.7. In doing that, this has shown desperation. The order is filled almost instantly as well. So if you're seeing that, this is a very good sign that people have reached a point where they've realized this is a good place to sell. They're happy to sell a significant amount here. This gives you a chance to go against the order. I wouldn't be looking for much if I'm taking this trade on, and equally wouldn't be willing to take too much risk above the high of the day. So you'd be looking just up here. If we start trading up to here, purely order flow perspective, be out of this trade. You won't see this come off quite quickly. You're not looking for much. It's a quick scalp. And that's the going against it. Once it's chased, shown the desperation, you can then go against that large order. So we have it. Two versions of it in the T-note. Much steadier on that push down. It was a kind of measured attempt at moving the price down. The second one, it was a much clearer panic. Someone clearly had to get that 3,000 lot done before the close of the day, and they rushed this up as we approach the end of the day. Next up, I want to tackle a trade called a behind the elephant trade. Now, there's differing ways to approach this type of trade. But the whole idea of it, and we've looked at a similar kind of version of this with an absorption that fails to then break and get continuation. Think about that gold one that spiked up and then reversed. Similar principle, much more obvious again. The large order is going to stop the market. So you have a large order that creates a low here. Market gets stopped. The assumption is, as you would do if you took this trade on as a front run, there are likely to be many stops just below the large order. So we've got that going in our favor. Meaning that if the large order breaks, you should see this quick zip down as the market goes through that large order. But to maintain this break, you need new participants. If people don't come in and sell after the break, it's not going to keep on going down. And then, as you come back above where that large order originally was, now it acts as support again, like we saw with the absorption or iceberg version. Occasionally, in a situation like this, you may get the large order actually return. So say it's 1,000 lot, that gets filled, market drops down, bounces back, and 1,000 comes back on the bid. What's happening here is the person that's bought, quite possibly, and you're never going to be able to know this, quite possibly, it's got filled, creates the sense that the large order is gone. And as the market drops, they will then buy into those sellers, trapping them. And then as the market comes back above, they put another 1,000 to buy as well. And if they can get filled on some of that, that then shows the strength again, forcing all of these sellers out and anybody who was considering buying it to now rush to buy. So they create this sort of situation where they get filled and then essentially kind of pull the market down like a slingshot to shoot it up. Very clever piece of execution to do that. So this then effectively acts as a level, but one would expect this move to be quicker now because people have realized that this clearly is a market that has got a solid base to it. The key to taking a trade on like this and the way to try and approach it is to either wait for it to come back above this level and buy, or alternatively, as long as you're not seeing any continued selling below the large order once it's filled, you can then buy into that. When you get this lack of continuation, you potentially get some absorption at lower prices, you can buy into that to send the market back higher. So let's go and have a little look at this as an example. This is one that we're going to have a look at in euro. What we get then, large order. It doesn't create any bounce away from it. So there's no real reason that you would want to front run this because you're not seeing any reaction to that order. It gets filled and this creates this quick little zip down. This is the point where you're thinking, right, potential hide behind the elephant trade. And one way you could do it is to actually put some bids in behind it. You can see the large order down here at 80.25. You could put some bids below this. Alternatively, you wait for it to drop, and then when it doesn't continue, then you have a go at buying it. The key to this, selling doesn't continue, volume, velocity dries up. The market just slows down completely. When that happens, then you can buy it. And as soon as you get back up above that 1802.5, that's where you can now expect the market to begin to rally. So that's what's going to create the acceleration back towards the upside. If we get this one going for you, we'll see what happens here. So at this point, like I say, you're not looking for a great deal. There's nothing obvious going on at this point. There's no reason to rush to take this trade on. It is merely a case of being very aware of the large order, Like with that pound one the second time where it dropped down to it but doesn't rush through it, you don't really want to be entering ahead of this. If anything, having seen this here for a while, as we see there, you could have a go at selling to try and play the break of the large order. And we'll talk about that, what we call a hit and run trade, in a little bit. So the key bit now is what happens when it trades 1802.5. That's the bit that really matters. So here we come. What's going to happen? One lot, bang, straight through it. You get that quick little zip down, which is what you would expect. But straight away, feel how slow the market's gone. Passive orders not moving, no further selling. So back above 02.5, this is now a reason to get out of the trade. Could have been much, much more aggressive on this. Could have been much quicker to actually get into the trade here as well. And that's the danger with a trade like this. You've gone for the move through, you need to be quicker getting in. Without the expectation of the court behind, or the hide behind the elephant, there is always that risk that as you come back above 02.5, you get trapped with many of the other people looking for that scramble back up. And so therefore, as the market comes back up now, 1802.5 effectively becomes your area of support. It's support here because of the large order. We saw a quick flick through and it effectively creates a mini head and shoulders. Market then starts to rotate itself back towards the upside. That's where you want to try and have a go at buying. You want to be trying to get in just down here, looking for this move back towards the upside. Simple trade. It's the hard part of a trade like that is the concept of where do you take it on? And how do you define when it's going to be a behind the elephant trade? One way of approaching something like this is if you are in a situation where you have this as a level anyway. So let's say you've got that 1802.5, or even better, you've got 1800 as your level. In this instance, we don't trade down towards 1800, and the market actually trades down to 01 and then bounces back. So this gives you a scenario where the large order and the court behind the elephant actually plays in your favor, because it creates a situation where you can now buy it above the level that you wanted to, but with clear reason to do so. People often look to get in ahead of the level, and I often hear people say, oh, well, maybe I should buy it 2-3 ticks ahead of the level. My argument to that is always, if you buy it 3 ticks ahead, why not 4, why not 5, 6, 7, 8, 9, 10? Before you know it, you're buying the place that you want to get at. But in this situation, you now have reason to get in without the market trading the point that you want. So it's almost a situation that you have as a mechanism to enter a trade, as opposed to something you're going to commonly be looking for. It also here as well presents the opportunity, particularly when it slows down, a way to enter ahead of your level as well. Because the market completely runs out of energy, the chance of it reaching 00, if that's your entry point, is not there. And so therefore you can, again, buy just above, your stop's below the level, same place. Yes, you're paying 1 or 2 ticks more, but you've got so much more information now that says it's worth paying 1 or 2 ticks more. The plan of the trade is still all the same. And you're just paying a marginally higher price, but for much better information. And now when you come back above 02.5, you've now got that extra conviction and you can add on to this trade. So that's the concept of a behind the elephant. Not something you're going to see commonly, and something that's more a trade that you're looking for in a certain situation, a way of enabling you to play something you already want to trade, as opposed to a way of always executing with reference to a large order. Right, moving on then. Hitting into and breaking large orders, what we call a front, from where the slide changes. So, moving on then to hit and run trades. This is all about breaking large orders, and there are different ways that this can happen, but the basic essence of it is using the large order as an entry point. You're essentially using it as your liquidity. If you want to sell, somebody offering you a wonderful price, a very, very large bid, is ideal. This means that you can sell as much as you want, or as much at least as is on the bid. And in taking that bid away, you're also creating pressure within the market. You're showing that there's a willingness to sell. And so therefore, you hitting through the large order contributes to the pressure in the market and the perception that this market is now about to move. So we're using the large order for our liquidity. It will create a point of interest, as it typically does. This is usually going to be a large order that's not moving. We looked at an example in the 5-year just now, one that moves and then hitting into it for a quick sort of scalp reaction. This is more going to be a situation where you're actually trying to play through the large order for a more directional move, a move that you're perhaps already looking for. What typically you're going to get then is a situation where people will front run the large order, as we have already seen. They get in ahead. Now, as we know, they are looking for a bounce, some kind of reversal type move, ideally for many of them. Over time, if this doesn't happen, what happens is these bounces get smaller. And whilst you may not be able to see this on a chart, it can often create a kind of flat bottomed wedge where the market continually bounces off the large order, but to a lesser and lesser degree. And in doing this, you end up with a situation where pressure builds. Think about it. If you were front running the large order, if you're long here or here or here, you're not getting paid. The market doesn't push far enough on side. And what's also happening is you're increasing the number of people who are long. We now have lots and lots of people who are long, who all need to sell to get out, who are all looking at the same price to get out as well. They're all going to hit into the large order if we get there. So straight away, you're in a situation where you've got sufficient liquidity to drive through the large order. You've got a market that has the scope to move because it's clearly showing there's a lack of willingness of buyers to actually drive this any higher. And so therefore, you're likely to see this quick drop where you have very little liquidity below the large order. And this can evolve in a number of ways. It can evolve in this way where we create pressure on the level, potentially where the large order gets reduced each time we go down. And we'll look at that as an example just now. So you're trying to build up information that suggests to you that this large order can break and that you have reason to believe that that break is coming. That's what you're trying to gain. That's what you're trying to get to. So let's go and have a little look at an example of this. This is a more technical one. So this is a trade where you'd be looking to get short anyway. Large order appears at the level. Somebody wants to buy that level. And so this is what I call a technical pressure hit and run. Pressure builds on the level. You have buyers who are not getting the move that they're looking for. People buying down here are looking for this type of movement. When the market instead just rolls back over and now cannot bounce off the low, this is the time that you're going to want to try and take the trade on. Unlike the first time, which comes down to it hits the order and gets a little reaction away. So I'm going to break this up and I'll show you this as two parts of the trade. We'll look at the first reaction to the large order and the bounce. This comes in at around about 40.80, and then we'll skip forward and look at the break through the large order. Once broken, you're then on to a more directional move. The nature of that move is going to depend on market context, where this move is moving into. Are you moving back into a congested area? Are you moving completely out of a range? You have to decide what you expect this move to be. But initially, you expect this to zip you on side, meaning that you've now got that sort of little barrier of comfort and also the knowledge that the large order has been broken. The reason for the market to not go down has gone. So you kind of open the gates to this move lower. So let me bring this one up and we'll go and have a little look at what exactly happens. So we can see the large order, 270 sitting down at 40.80. This is the first time it's hit. And so as we come down, we can then get a bid ahead of the large order, looking for this kind of reactive bounce back up the range. So nice, dead, simple trades. Another large order just ahead. There was 100 there. That's just got filled. Now we see this little tick down. Get filled just ahead. With this being oil and the expected kind of size of a bounce that one might look for, you can be willing to pay a slightly higher price. You know that other people are going to be aware of this large order. And for that reason, you might then want to get in ahead of the order so that you don't end up missing your fill if you wait for it to trade down towards 81. You see there, it does trade 81. You could have got filled because we do manage to trade into the 80. But that's not always going to be the case. And with something like oil, because your payoff is likely to be 10, 15, 20 ticks, there is some degree of value in paying an extra tick or even splitting your order 82, 81, so that you get the chance to ensure that you're in on this trade. It's still a relatively small risk for the pay that you might get. As we pick up a little bit of pace away from that large order, then you can start to add. Note here, we're now starting to tick up and you're seeing much more buying. You're seeing very quick hitting into offers. Anything that comes down, the bids just stay there. We hit into the offer. 84 starting to hold. So there's a little bit of willingness to reload there, but bang, again, finds it very easy. It's very comfortable to trade up and then hit into the next price. Much less comfortable to trade down. You see each trade down is maybe a 5, a 6. There we can see a 30, but immediately, as soon as that happens, counter move. Buyers come back, they take the offer away. So you're seeing this steady stepping up from buyers. They're becoming more and more confident because the large order's there. It's a bounce off a level. This is your opportunity to then play this move away. Those coming in a little bit later to the party are going to look at this and think, right, well, we've been shown that this is a low now. This is the chance to buy. Let's buy this off the level as the market then starts to bounce away. And it's exactly what we start to see. This gives you the opportunity to get out. It's a little scalp exit back up to where the volume was at around about 40.94. If you're looking for more, then of course you can stay in this, place your stop below 80, let the market play to the target that you have. It's all about what you're looking to try and do. So, second attempt then. This is the break. Now you already see when we get down here that that large order has either disappeared or split. So it was 270 and it got eaten up a little bit and it went down to around about 180. Now it's split between two sort of roughly 100 lot orders. Both of these are they're constantly fluctuating. So you might look at that and think realistically, maybe there's a sort of an 80, 90 at each of those prices that actually really wants this. The rest of it's sort of a few other orders. So now we're looking for the break. As the pressure builds, and this is the bit that I'm looking at, once you form this sort of smaller low before, and we now start to build a bit of pressure above the level, you can take some risk on here. On the basis that if we break this large order a second time, with a market that clearly has the pressure to take it back there, we're expecting this to be quite quick, quite comfortable to move through and then continue. So you can look at this, if you can define your risk as above the previous lows, so perhaps say 90, you can place your risk at 90. So you got risk at 90, you're short at 84, so you've got 6 ticks of risk. Your expectation is that on the break of 80, you're going to see a quick move down and then potential continuation. So being short at 84, by the time you get to the point where the acceleration is going to come from, you're already 4 or 5 ticks on side. The pressure continues to build. We're not bouncing at all now. And this is good to see. This is what you want. What this also means is anybody who's not short and considering selling is all going to be looking at the same price. They're all looking at 80 thinking we can sell into that. There's only 100 contracts there, 90 contracts there. So not everybody's going to be able to get filled. And it's for this reason then that you get this quick move, because as people try and get in, the order gets depleted, bang, it's gone. Nice and quick. Now anybody who wants to sell jumps on the offer. They're trying to get the best prices available, 78, 79. And this pressure now is what prevents the market from getting itself back up. So it sticks below 80. And now you can be confident of the move. Now you can add on to this if you want to and try and play for a larger target. If you have a bigger target in mind, this is great to play for. You can be in a situation where now you don't need to put your stop at 90 anymore. Your stop can come down to maybe 82. There's no need for it to be much higher now. We're through the level, we're through the large order. Think about that behind the elephant trade. If we get back above 80, everybody who's been selling down here is now potentially trapped. So that's your danger. But at this point in time, there's no reason to get out. Yes, the market is not rushing towards the downside, but we're still holding reasonably steadily. Now you get a little rush down, the little acceleration move. This is perfect. This is what you want to see. It allows for a continuation. You can now be very, very confident in this. You've pushed through all of the reasons that this has to bounce, and now you get continuation of this movement. Little acceleration, little snaps down, everything that you would want to see on a move like this. So there you have it. That's your first hit and run trade, a pressure into a level. Technical move onto a level, pressure builds, snap. It's like kind of putting weight onto a trapdoor. The trapdoor can only hold for so long, and the more weight you put on it, the more it's going to snap through. And once it does, you can't then get back up. And that's what then drags this market lower. Next up, something that will help with hit and run trades is correlation. Not something that we've covered too much just yet, and we'll cover this much more when we look at macro trades. But with correlation, what you've got to be thinking about then is equivalent markets. So this is an example of the Bund and the T-note. What we have in the Bund is a very obvious large offer, 3,700 sitting at the high. So we can see this, and you see how the market has traded up to it and reacts back. So great. We can see that there's a reason for the market to back off from this level. But your correlated market can give you a great clue as to whether this is likely to break or whether this is likely to hold. The way that you do this is by looking at the equivalent reference point. So when the large order is hit, where's a correlated market trading? This is T-note, and that effectively creates the same level in the T-note when the large order gets hit. So now what you're watching for is when the markets both come back up, if the T-note drives on as it does here, you can now be confident that the bund needs to play catch up essentially. So this large order is no longer going to be so able to hold because it's not holding just simply the bund, but it's holding everybody who's looking at this as a spread trade. So the way to think about that is if the two markets are trading together and the T-note suddenly rises in value, there's a trade to make their spread equivalent again. And the way you would do this is to sell the T-note and buy the bund. Seeing as there's now 3,700 contracts available to buy in the bund, you can put on a very large spread and capture a few ticks very quickly as that spread re-equalizes. So it gives you a reason to think this large order is going to break because simply the T-note continuing towards the upside cannot sustain or cannot allow, well not allow, but the bund is not going to be able to sustain selling, seeing a correlated market continuing to push towards the upside. So it's using correlation to give yourself this skew and the ability to time when this break's going to come. If you've got a market that's holding against a drive higher, it's going to struggle to hold. And for this reason, you're then expecting the next time we get up there for this one to break. The large order breaks, you're then going to get this catch-up move. So the bund's then going to accelerate quickly to catch up to what the T-note has done, hence this quick jump towards the upside. So let's go and have a little look at these two markets playing the move at the same time. So you've got bund on the left, T-note on the right. You can see really obvious large order, 3,600 sitting at 56. And what you're looking for then, the equivalent price in the T-note is 20, so that's right where we're currently trading. T-note goes bid. This is the last time that we traded up at these prices. T-note goes bid, bund's holding the offer. So at this point you're thinking, okay, not a great deal to be done here, but I'm very aware that the T-note is still holding a bid and I've got this large order. At this point as well, we've also traded this level multiple times. And each time we've pressured ourselves slightly closer. The pull away from the level has been less each time. So again, you're now looking at this thinking, well, where's the value lie in this trade? Does it lie in continuing to sell? Or does it more lie in playing through this and catching out all the people who potentially could be stopped out if this large order breaks? So you can see where the opportunity lies, and now it's just a case of waiting to get some information. This is why you need both markets next to each other. You want to keep your eyes on that T-note. If the T-note starts to tick up, you can now start thinking about buying the bund. You want to see the T-note start to trade through 20, as you see there, starts to get a bid. Now's the opportunity to have a go at buying the bund. You can buy ahead of the level because the T-note's already shown that strength a couple of times. The T-note has been comfortable to take 20 bid, now trades 20 and a half. So theoretically, it's not a major change, but just with the T-note trading here, theoretically the bund should at least be trading at the high. And there we see more absorption in the T-note at 20, holds a bigger bid, 900 now comes onto the bid. You're now expecting the bund to start to make its move towards the upside. This is where you can add and build your position early ahead of the large order, with the expectation that this is going to break and you can see a quicker move. There goes T-note, we trade 21, 21 and a half, 22. So the bund theoretically now should be trading above 56 and it's not. This is now where it was getting you thinking, right, this moves on now. The T-note's still holding up there. So we're still looking good for the break. You're just now biding your time. You can continue to build the position, hold on to your position here. There's no reason to get out. If you're looking at that equivalent point in T-note, 20 is the equivalent of 56. So based on the T-note, the bund should be higher here. You can be confident now that this break is likely to be coming reasonably soon. There we go, now trading into that large order. What you want to see is pace. Bang, the large order gets taken out. We're through now. So now the bund can play a bit of catch up. It's got to at least get towards 22, which is going to give you an equivalent of at least 60. But because of the pressure that's been created by that large order and a large number of people short below it, you now get the bund, in fact, actually jumps towards the upside. Shorts are forced out, the market goes pop, pop, pop up, and this creates this very quick flick, jump up. You don't need to be looking for much here. You get another large order chases up. This can provide you a little bit of support, an opportunity to exit your trade if we start to trade back through. Flicks back through, you can exit your trade here. Reduce your size down, try and get that last order out if you possibly can, particularly if T-note's still ticking through highs. This then still allows you to exit that trade. But the key to this is understanding the equivalence between 20 and 56. And as the T-note ticks through that level, the bund should be higher. And this says to you, you can play for the break of the large order this time. Don't worry about playing for any kind of pull back from it, any kind of stall around that large order at this point in time. Okay then, next part using a large order is what I call a momentum hit and run break. So far we've looked at correlated, we've looked at pressure building, now we're going to go and look at momentum. What we're looking at here then is an obvious large order, and often this can be at a breakout point, it can be something standing in the way of a directional movement, but the key to this is a market that maintains pace as it approaches the order. If you're looking to continue direction, so for example you're looking to try and play this to the upside, you can see the large order at the blue line. What's crucial then is that as we drive towards it, that the pace of the market, the velocity, the volume traded increases, or at least stays very fast compared to what you would typically expect. So normal circumstances, market might be trading in a certain way. If the pace has picked up and maintains that additional pace as you approach the large order, this is your opportunity to, again, use it as liquidity, hit through that, and it will create a sort of short-term barrier. People will stall thinking the large order might hold. If they don't get any bounce, think of those profit takers ahead of a large order. If you don't see a bounce away from it, this is where, bang, the large order will be traded through and the market will continue to jump or continue to fall. So, they act as a barrier until people don't believe it's going to hold. The rush towards it is what's going to give you the opportunity to get in. That's the bit where you can buy ahead of the large order as well, on the expectation that with this increased pace, it's going to hit through it. That's one way to approach this. Alternatively, you wait to see the velocity staying the same as you hit the large order. As long as it's hit, maintains this pace, you can hit into this. You can hit through and then expect a continuation of this movement. Once you've gone through, this essentially acts as a stop. So whilst the large order that chases acts as a moving stop, this acts as a kind of instant jump stop. So you can get long here, your stop immediately jumps to here once you go through that large order. I'll give you an example of this. I'm going to look at the S&P on a momentum move. So a market that's already picked up some momentum, it's already moving quick. And I'll also show you this in correlation with multiple other markets, so that you see the kind of entirety of what's going on, as opposed to just purely looking at one market in one situation. We're going to have a look at the S&P, gold, euro, and the 5-year note all at the same time here. So whilst we're going to be focusing on the S&P, there are also opportunities to spot action in other markets. You may well see entry points happening. You may well see some other large orders in other markets at the same time. So let's get this up and we'll get this one playing. Okay, so as we come into this situation, what we've got is a position short in S&P as this little flag begins to break, and we're looking now for another shot through the recent lows at 39.80. Also got a long position in gold, attempting to play the bounce from the low in gold. At this point, gold's offside. Stop's going to be as we start to approach the low. Don't want to try and hold on to this trade if this market is going to continue down and get dragged down with the others. So the main focus is going to be on the S&P and the opportunity to add on to this by hitting through momentum breaks of large orders. So a hit and run with momentum on this one. You may see other situations and similar things happening in other markets at the same time as well. Okay, here we go then. S&P just starting to tick on side. Little bit of momentum starts to pick up. We have got a large order on the offer, which is helpful and should add a little bit of conviction to thinking that this trade is likely to start to run further and further on side. With this being on side, gold is perhaps the bigger focus here, not wanting to end up with this running against you. Large order sitting at the low in gold as well. So this illustrates the way people are going to think. If people are long up here, this effectively acts as a stop. If the market hits through the large order, this can be the stop and the reason to get out of the trade. And there we go, that large order actually just jumped up. It's gone, lack of reason to be in the trade anymore, and then hits out into where that large order was. There's no reason to still want to be in this trade. So now we're seeing markets continuing onwards with what they're up to. Steady movement towards the downside in the S&P, and we'll continue to see this little bit of a push further on. At this point, you'd be looking at this thinking, right, my target is at least to break through 80, and then there's a much bigger target to the downside of 57. So gold's gone and broken the low. For 5 years sitting at the low. The euro is starting to see a little bit of stabilisation, just bouncing off the low somewhat. So at this point, nothing really jumping out in the S&P, and you're just then thinking, right, well, we're going to look down towards 80, and then, so the plan going through someone's head is, right, well, I don't have any reason to add in here, but if we get down to 80, one way to do this is try and hit the market through the low. Doesn't matter what's at the low, you might be willing to just hit it through the low anyway, expecting acceleration as the market breaks. So you can be reasonably happy on this trade, just simply to go, right, break 80, sell more. Where a large order appears, this then gives you extra opportunity. This then gives you the extra chance to add on to the trade, because you now get a situation where you've got a large order that now says, right, you can now play the break on this one. So there we go, down towards the low, and we've got 270, bang, we hit straight the way through that, and we added into it almost instantly as we went through that 270 lots. So we've got another couple short here at 78.5. The market continues to move to the downside. This is just what you want to see. So continued push down. Now looking, you're going to have in mind 57. There's another 200 down at the low here. So there's another opportunity to sell. You're going to keep eyes on that. You're waiting for this to break and you're thinking, right, if we get down to that 200, I can hit into that again and effectively bring my stop down. I'm 10 handles past the 80s, which was the previous low. We've got another large order here. If we can hit into this, no bounce away, there we go, 300 hits into it. Quick hit. So add another couple short. We've traded through. You can now look at 69.25 essentially as your stop. If you're looking to play a larger move, you then have a discretionary element of saying, right, well, where we've got this low volume, could place my stop up at 71, 72 to ensure that we don't end up just getting flicked back to 69.25. But you can see here the pressure does remain. The market continues to push on towards the downside. We've still got further scope for continuation now. So you'll be watching this. If we do start to push back above 69, then you can get out of the trade. So a couple taken off the position just there because we did start to come back above 69 as other markets all started to bounce off lows as well. S&P continues lower though. So there's still reason to think, right, well, 57 is entirely on the cards now with 30 handles from the entry point. And you can now continue to look at this as we keep putting in these pockets of low volume, which we're going to cover when we move on to momentum. They can be your points of support, reasons to get out of the trade. Once we've jumped back up above that pocket of low volume, there's your reason to exit. Back above 69, equally more reason to get out of the trade. And as I say, looking up towards 71, 72, there's your exit, trade is done. But the main aspect of that trade was about getting into this as that move happened. As you got through those large orders, the one at 80, the one that came in down at 69, hitting into those gave you opportunities to pyramid the trade. But you're doing so at a point where the market has the momentum, it has the potential. So you're using that liquidity to get your position done. And by doing that, you're eating away at the large order, which reduces the barrier to the market going down. So it's a great way to enter. You know, if you're looking at a market moving and you're looking for an entry point, don't look at a large order necessarily as being something that's standing in your way. Look at it more as an opportunity to get your business done by hitting through that liquidity. Right. There you go. Great example of large orders with momentum. I will share this as well on the portal so you've got the entirety of this move because there's a couple of other examples within this of both front runs and of hitting through large orders as well. So you can see the entirety 15 minutes from the very beginning of this move in S&P, gold, 5-year and the euro, and you can see some of the movements in each of those. On that then, we will conclude large orders. We've looked at different ways you can trade them. We've looked at front-running large orders, both moving and stationary. We've looked at hiding behind the elephant, waiting for a large order to be filled and then showing no willingness to continue. And finally, we looked as well at momentum breaks of large orders, hit and run trades, be that pressure building above them, whether that is a correlated move as other markets drive on. And then the final one that we looked at, a momentum break, which also in this situation had an element of correlation with it. Correlation is important. We'll look at this in future weeks, but it's a real key thing. Whenever you're watching one market thinking, will we break, won't we break? If another market supports the idea, then that is going to massively help your trade out. I'll wrap it up there, guys. We'll be moving on now to another version of large orders, but looking at them from a flipping perspective. So now, people taking advantage of large orders or of the reaction to a large order and using this as a way of manipulating markets. That's what we're going to cover in flipping manipulation.